Dear students, good morning. Today we are taking up the second approach to value-based management. We have seen the last session what is called value-based management, and we looked at the various 5 approaches towards value-based management, and we looked at American model of value-based management, which is based on market to book value ratio. So how the company can enhance the market value of shares, which is the value for shareholders. As long as the return on equity is greater than cost of equity, there will be value to the shareholders. There will be increase in market price. There is increase in growth rate and dividends. So that enhances the value of shareholders that we looked at, and we have seen the case study based on the American model. And today we are looking at the second value-based management approach, which is known as Alcar Approach. Alcar is one of the famous international management consulting company in the US, which has developed this approach called Alker Approach, which is based on the book which was written by Alfred Rapport, on creating shareholders value, which is the title of the book, which was written by Alfred Rapport, who is known as the father of shareholders value. Based on that book, this particular model has been developed. So based on that particular book, Creating Shareholders Value, there are 7 drivers which can create value for shareholders. They are called as value drivers. So look at this graph, look at this chart, which was developed by Alker. The bottom of the graph, the bottom of the chart, we can see 3 major decisions of any company. There are 3 major decisions of any company, known as operating decisions, investment decisions, and financing decisions. Among all the 3 major decisions, these 3 decisions, the foundation of all these 3 decisions is the financing decision. The financing decision deals with raising funds. So the basic factor in financing decision is a cost of capital. The overall cost of capital, that is known as the weighted average cost of capital. So the financing decision, if you move up, what is the arrow mark, what is given is the cost of capital, the overall cost of capital. So the company's overall cost of capital must be minimum. We call it as the weighted average cost of capital. So that must be minimum by employing more debt. That's why another arrow mark you can see on the top, it is connected to the debt. When the company employs more debt, the overall cost of capital must be minimum. When the company employs more debt, because debt has tax advantage. There is no limit for paying the interest expenses on the part of a company. The company can pay any amount as interest as per the income tax rules. Not only here in India, anywhere in the world, even when you look at the federal tax law in US, there is no limit for the interest expenses. The company can borrow more, the company can charge any amount of interest in their financial statement, so that the company can report less profit, and thereby the company can pay less tax. So the basic factor in lowering the overall cost of capital is through employment of debt. That is the financing decision, then cost of capital and debt. And then the second, once the fund is being raised, the companies have to invest in the assets. The assets, the form of fixed assets and working capital. Fixed assets for establishing business, working capital for maintaining business. Fixed assets is for establishing business establishment, and working capital is for maintaining business establishment. So investment in fixed assets, investment in working capital. So investment decision, when you look at the above the arrow mark, it touches working capital management and fixed capital management. Then the third, once the assets are being employed, the funds are being deployed, and the companies need to raise return. The company need to raise a profit. So there are three major factors, three major value drivers in operating decision. That is the operating profit margin and sales growth and income tax rate. The companies need to raise, the companies need to increase its sales, and thereby the companies need to increase its operating profit, and the income tax rate plays an important role in having, the reserve the company has got. If the company need to pay more tax, and then the reserves what the company has got, it will be less, because the companies need to pay more tax. The tax rate should be, the company should pay less tax. That means it's a part of the policy of the government. The policy of the government which reduces the income tax rate. So these are all the three major value drivers of operating decision. So there are 6 value drivers under 3 major decisions. One is operating decisions, sales growth, profit margin, and income tax rate. Investment decision, we have 2 major value drivers, that is fixed asset investment and working capital. And financing decision, the major value driver is cost of capital. And besides these 6 value drivers, we have one more value driver called value growth duration. Value growth duration. That refers to the number of years the companies can earn more rate of return than the cost of capital. The how many years the company R is greater than K, that period is called value growth period, or we call it as value growth duration. So value growth duration refers to the number of years that the company is tend to earn more return than its cost of capital. That is, if the number of years is 3, the value growth duration is 3 years. The number of years is 5, that is R is greater than K, the value growth duration is 5 years. So these are all 7 value drivers. 7 value drivers, that is value growth duration, sales growth, profit margin, and income tax rate, working capital management, and fixed capital management, under under investment decision, cost of capital, under financing decision. And all these enhances the cash flow of the company. All this enhances the cash flow of the company. That is one of the valuation components. The valuation components are the cash flow of the company, discount rate. The discount rate is the cost of capital. The overall cost of capital must be low, and when the overall cost of capital is low, when the company employs more debt. So that will in turn enhances the value of the shareholders, which is one of the major corporate objective. The companies are existing for enhancing the value of their own shareholders. That is called creating shareholders value. How the companies can create value to the shareholders? By distributing more dividends and by enhancing its market price. So the market price is higher, their capital gain will be higher. The capital gain refers to the market price and the book value. The book value is less, the market price is higher, there is a capital gain, and when there is an increase in capital gain, that enhances the value of the shareholders. So this is the model that Alcar has developed for creating a value for its shareholders. So when you are asked to write theory question, so you need to explain what is Alker and explain these 7 value drivers and write this graph and give the conclusion and write the steps in calculating value for strategy. So that we look at. So according to the Alcar approach of value-based management, a strategy should be implemented if it generates additional value for the firm. So here in case study, the case study will be how a business strategy can create value for shareholders. A business strategy can be employing a business ambassador for the brand, or starting a new branch, or procuring a new mission for enhancing this production, or starting a new brand in the total basket of brands, and or introducing a new production method, or changing technology in production. All these are all known as business strategy. So how a business strategy can enhance the value of the shareholders, that's what we are going to look at in the case study. So what will be given is, you will be given a particular strategy, a particular business strategy, and this strategy is adopted only for few years. See for example, when you look at the Mysore sandal soap, which is the soil of our own soil company, a Karnataka detergent company, which is located in Yeshwanthpur in Bangalore. That particular company, the Mysore sandal soap, was about to be closed. I'm talking about a decade before. The big company located in Yeshwanthpur, I'm talking about the brand called Mysore sandal soap. That company is owned by government of Karnataka. It was about to be closed down due to huge losses, and there's a lot of competition for the soap, because you have a Unilever, you have a Godrej. These companies are competing brands. This particular company could not survive, lot of losses, and then the company was about to be closed. So at that time, I'm talking about 14 years before, at that time Dhoni was emerging. You would have seen Dhoni comes as a wicket keeper with a long hair. So he was approached, and he was a brand ambassador. For Mysore sandal. So when you look at in Google search, you can see that. So he was a brand ambassador for. So this particular, he was just emerging. He just started his career in Indian cricket that particular point of time. So that at the time, the amount was the amount which was given to him. It was 75 lakhs. It was only just 75 lakhs because he's a young cricketer, just joined in the Indian team. So it is for 3 years period. It was 3 years period, 75 lakhs. Today if you approach him after less than 7 crore, he will not come. So 75 lakhs, and that's a turnaround strategy. So that was a turnaround strategy of the entire company. Then what happened was, the moment the Dhoni came, and then it got picked up, and then today the company is surviving. So this particular strategy for 3-year contract is a business strategy. There's a business strategy for the company. That was a business strategy for a company, and then the moment Dhoni comes for the advertisement on the media, immediately sales will not increase. Immediately people don't rush to the market, because he was a young cricketer. Nobody knows who is Dhoni at that point of time. So immediately the effect will not be there. The effect will be a long term. But the contract is for 3 years. So that particular business strategy has turned around the entire Mysore sandal Karnataka detergent company, which is located in Yeshwanthpur. So that is only for 3 years. So this particular strategy for 3 years, so what is the sales and what is the profit and what is the cash flow, all this will be given. So we need to calculate the cash flow. And this particular strategy will be forever, because the company is forever. The company is forever. The company is, it will not be, the moment the strategy is employed, the company will not be closed. So the company should come out with a new strategy. The case study will be, you will be given a strategy and we'll have to calculate the cash flow during that particular strategy. That's the first step. We'll have to calculate cash flow during that strategy. And then we'll have to calculate the present value of cash flow. And then we'll have to calculate the residual value, that's called perpetual value, because company is forever. So we have to calculate the residual value and add both. So that will give us the total shareholder value. Then we need to calculate pre-strategy value, that is before this particular strategy is adopted, what is the value for a shareholder, pre-strategy value. So already we have calculated a post-strategy value. Compare post-strategy value with the pre-strategy value. The post-strategy value is higher than pre-strategy value, then that creates value for shareholders. So that particular strategy needs to be adopted. The post-strategy value is less than pre-strategy value, so that particular strategy may not be adopted by the company. So that is a case study which we need to look into. So look at the following steps are involved. So first you calculate the cash flow. Cash flow we need to calculate. Calculate profit after tax, add depreciation, and then minus the changes in fixed assets, minus changes in working capital. So that will give us the cash flow. Then calculate the present value of cash flow. Calculate the present value of cash flow. And calculate the residual value, that is the company's forever, after the strategy is being adopted. Calculate the residual value, perpetual cash flow. That is called cash flow divided by cost of capital. Add both, add step 2 and 3. So that will give us the post-strategy value. And then calculate, the fifth one is calculate the pre-strategy value. That is cash flow before new investment divided by cost of capital minus market value of debt, if any. Then calculate the value of strategy. That is post-strategy value minus pre-strategy value. The post-strategy value is higher, then that particular strategy creates value for shareholders. So that strategy needs to be adopted. If the post-strategy value is less, so that particular strategy may not be adopted. So that is the steps that we need to follow. So this is what, if you are asked to write a theory question on Alcar Approach, please write first the Alcar, what is Alcar Approach, and then write these value drivers, what are those 6 value drivers, and value growth duration that you need to give an explanation, because the remaining six are self-explanatory. That is growth rate of sales, operating profit margin, and income tax rate. All these 3 comes under operating decision. Investment in working capital, investment in fixed assets, that comes under investment decision. Then cost of capital comes under financing decisions, are all self-explanatory. And the value growth duration, that you need to give the explanation, that refers to the time period for which a strategy is expected to have higher growth rate than the cost of capital. So that you need to give explanation, and then write this graph, draw this graph, and write the steps involved in calculating the strategy value. So any clarification, anybody, before we go for case study? So the case study is, you will be given a balance sheet of a company. You will be given a profit and loss account of a company, and then you will be given a strategy, how this strategy is employed in a company, and what is the effect of that strategy, how the companies have increased its sales, because the moment the company adopts any strategy, that sales should increase. That is the bottom line. The bottom line of any company is a sales. The moment the Dhoni employed and sales picked up, sales picked up, and today the company is existing. Today also you could see Mysore Sandal soap in the outlets. It is because of that particular strategy the Karnataka government got employed at that particular point of time. Okay, so he revived the entire company. Dhoni revived the entire company when they started a new plant. Dhoni was invited to be the chief guest for opening that particular plant. So he revived the entire company. So it is not forever. This particular strategy that we adopt by the company is not forever. So he cannot sign a contract forever. So he signed a contract only for 3 years at that point of time. Okay. So I mean, then how many years the strategy is employed and what is the effect of the strategy? How much percentage is increase in sales that it will be given. So accordingly, you will have to calculate increase in sales and increase in profit, and then we'll have to calculate profit after tax, and then we'll have to calculate cash flow, that is profit after tax plus depreciation minus changes in working capital and changes in fixed assets. That we'll have to calculate. That will give us a cash flow. That's the first step. And the second step, you'll have to calculate the present value of cash flow for those 3 years or 4 years when the strategy is employed. And then after strategy is employed and the company is not closed, the company is forever. So it's called, we need to calculate the perpetual cash flow, residual value. It's what we call residual value, that we need to calculate. And both, that will give us the total shareholder value, or we call it as a post-strategy value. Then calculate pre-strategy value. Pre-strategy value, that is before the strategy is adopted, what is the value of the company? What is the value of the company? What's the value of the strategy? Compare pre-strategy value with the post-strategy value. Post-strategy value is higher. We need to recommend the company to adopt that particular strategy. So, any clarification, anybody, before we go for case study? Anybody? Anything anybody want to ask? Any clarification, anybody? This is a case study. Yeah, the Alcar Approach case study is given. The income statement for the year and the balance sheet of the year is given. Infotex Limited. Income statement sales is 50,000. Gross margin, there is a gross profit 20%. 20%. Sales and general administration expenses 8%. That is 4,000. 8% of 50,000, 4%. Then profit before tax is 6,000. That is 10,000 minus 4,000, because gross margin is 10,000. Gross margin is 10,000. Okay. Gross margin is 10,000. That is 20% of 50,000, 10,000. So 10,000 minus 4,000. Then profit before tax is 6,000. Okay, tax is 4,200. 4,200. The profit after tax is 1,800. Profit after tax is 1,800. Okay, it is given. Then balance sheet, fixed assets 25,000, current assets 5,000, equity 30,000, no debt. The company doesn't have any debt. Infotex Limited is debating whether it should maintain a status quo or adopt a new strategy. They are deliberating whether they should adopt a new strategy or they should maintain a status quo. When the moment the company adopts new strategy entails expenditure. So please look at, no, you cannot adopt a new strategy without incurring any expenditure. So there will be an expenditure. So that expenditure generates revenue. So Dhoni was paid 75 lakhs at that point of time. So that turned around the entire company. Okay. So So it incurs the expenditure, so they are deliberating whether it should maintain status quo or we need to adopt new strategy. If they maintain status quo means they maintain the same condition. Status quo means they maintain the same level. They don't adopt a new strategy. At the same level if they go, that is called the status quo. If it maintains status quo, the sales will remain 50,000. The gross profit will remain 20% on 20%, selling administration expense to 8% of sales. Depreciation charges will be equal to new investment. The asset turnover ratio will remain constant. The asset turnover ratio. The asset turnover ratio. Anybody? What is called asset turnover ratio? You have studied in anybody? What is called asset turnover ratio? Anybody? Hello?
Sir, is it total asset upon average?
What is that? How do you calculate? What's the equation for asset turnover ratio? Anybody?
Sir, it is net sales divided by average total assets.
Oh, very good. Who is that?
Olivia.
Who?
Olivia, sir.
You didn't get any mark, no, earlier?
So once when you called my name, that time I was busy with the placement thing, so I missed that chance.
Okay, now you get 2 marks. Raghavi? Raghavi is there?
Yes, sir. Yes, sir.
Raghavi, Bolivia 2 marks.
Okay, sir.
Please give 2 marks. Very good.
Okay, sir.
So, how the assets are being utilized to generate sales? How the assets are being utilized to generate sales? That is called the ratio between sales and investment. Sales and investment. That is called asset turnover ratio. So, asset turnover ratio will remain constant. So, look at here. The sales is 50,000. Sales is 50 and net investment is 30,000. 30,000. Fixed assets, current assets. So, what is asset turnover ratio? 50,000 divided by 30,000. How much? 50,000 divided by 30,000. 1.67. 1.67. That is called asset turnover ratio. So you are employing 30,000. You are employing 30,000, but you are getting more than 30,000 sales. Okay. So the asset turnover ratio, it is low. I mean, it's always low. It is here it is low. It must be more than 2. If you employ 50,000, you should get 1 lakh sales. Okay. So the standard is for any company, it must be 2. If you are employing 50,000, you should get 2 lakhs. 2 lakhs must be your sales. If you take a fish market, that's what, look at the fish business or the hotel business, it is 4. Fish business is 6. That's why many are doing, what is that, when the fresh to home, these are all new startups. I mean, they got, lot of funding now. They got a lot of funding from other companies. Okay, the fresh to home, which is based in Bangalore, started by a few youngsters. You would have seen in the recent times. Okay, they got a lot of funding now. So any fish business, it is 6 times. So if you employ 1 lakh, you tend to get 4 lakhs to 5 lakhs. So that is the sales that you get. So it is not a profit. It's only sales. I'm not talking about a profit. It's only sales. So after sales, you need to incur a lot of other expenses. So that is the asset turnover ratio. There is sales divided by assets. So here asset turnover ratio is 1.67. That remain constant. The discount rate will be 14%. What is called discount rate? Anybody? What is called discount rate? The discount rate will be 14%. What is called discount rate? Anybody? Hello? Discount rate.
Bank rate is also known as discount rate.
No, bank rate is not known as discount rate. Who said? bank rate is not a discount rate.
Will be expecting
Ah,
one rate, and if they
okay,
get
okay.
below that rate,
Coming closer. Okay.
if they
Coming,
get the
yeah.
returns less than that rate is the
Okay,
discount.
coming closer. It's not a correct explanation. Coming closer only. Yeah. Anybody?
So the rate at which the dividend is declared.
No.
So the risk factor of any given investment.
No. Saral, very close answer, but not.
Sorry, present value of the future cash flows.
Okay, present value of future cash flow. What is the correct term? Discount rate. Anybody?
Discount cash flow.
Discount cash flow. No. Now also we discussed that. Here. Now also we discussed. The previous graph also chart that we have discussed. In chart it was there. Discount rate. Everybody? Not getting it? Okay. Let me show the chart once again. Let's see anybody is getting it. Okay. Look at this chart. What is given? Look at this graph. Chart. Discount rate is mentioned, no? What is that? Cost of capital. Cost of capital. So discount rate is called cost of capital. Discount rate is called cost of capital. Yeah, weighted average cost of capital. So on this cost of capital only we need to calculate the cash flow, future cash flow. That's what Faras mentioned. Present value of future cash flow we need to calculate. But the term is called cost of capital. Discount rate, the term is called cost of capital. Yeah. So the cost of capital is 14%. So on which only we have to calculate the future cash flow. We need to calculate. Okay. And then the income tax rate is given 30%. Now, this is the company, if they adopt a new strategy, they maintain a status quo. They maintain status quo, all these are all remain constant. Nothing is mentioned. Now, if the company adopts a new strategy, the sales will grow at the rate of 30% per year for 3 years. So what is the strategy period? What is the strategy period? Hello? What is the strategy period? Strategy period is for how many years? 3 years. The sales is growing at 30%. The sales is growing at 30%, profit will grow at 30%, and the investment will grow at 30%. The fixed assets you need to employ 30% more. And therefore, thereafter the sales will remain constant. So 4th year onwards, the sales will remain constant. That is a perpetual in nature. The margin, turnover ratio, capital structure, income tax rate, discount rate will remain unchanged. That is same 1.67, remaining income tax rate, discount rate, that is cost of capital, all remain unchanged. Depreciation charges will be equal to 10% of the net fixed assets at the beginning of the year. Depreciation charges will be equal to 10% of the net fixed assets at the beginning of the year. That we will see when we come to the case study. After 3 years, the capital expenditure will be equal to depreciation. After 3 years, capital expenditure will be equal to depreciation. That also we'll take it up when we come to case study. What value will the new strategy create? What value will the new strategy create? The strategy creates a new value. That particular strategy needs to be adopted. If it doesn't create any value, that particular strategy the company should not adopt. So that is the conclusion that we need to derive. Okay, we will start. So first the first step is you need to calculate the cash flow for the 3 years. Okay, cash flow for the 3 years. That is 0 year, 1, 2, 3, 4th year onwards. 4th year onwards. That is called residual value. 4th year onwards. Okay. So this is a strategy period. Strategy period is for 3 years. 1, 2, 3. Strategy period is for 3 years. So sales. So first step, you are calculating the operating cash flow. You are going to calculate cash flow, operating cash flow. The step 1, cash flow. Step 1, you are going to calculate cash flow, operating cash flow. Operating cash flow. Okay. Sales. Sales is for base year, the sales is 50,000. Base year sales is 50,000. It is growing at, the sales is growing at 30%. So the second year, the first year, the sales will be 30% of 50,000. 30% of 50,000, that will be 65,000. Correct? Hello? Correct? 30% of 50,000. 65,000. Got it? Hello?
Yes, sir.
Okay. Then 65,000, 30%. 65,000, 30%. How much comes? 65,000, 30%.
19,500.
90, yeah?
19.
Hello? 19,500. Add that. That will be 84,500, no?
Yes.
Correct? 84,500. 84,500. 84,500, 30%. 84,500, 30%. 84,500, 30%. 25,000. 25,350 means it will be 1 lakh.
9,000.
1,07,000, no?
109,850.
25, okay, 109.
109,850.
850. Okay. Now, 4th year onwards is a perpetual in nature. So 4th year onwards, the company is maintaining the same sales. No change in sales. That is 1,09,850. 4th year onwards, it is given there. 4th year onwards, sales remain constant, same, 1,09,850. Okay. Calculate less. Then gross margin, it is given. Gross profit. Gross profit is 20%. Gross profit is 20% on sales. Gross profit is 20% on sales. So 20% on 50,000, that is 10,000. 20% on 65,000, that is 13,000. 20% on 84,500. 20% on 84,500.
16,900.
16,900. Then 20% on 1,09,850. 20% on 1,09,850. 20% on 1,09,850.
21,970.
21,970. And again 21,970. Same. Then from this, there's a 8% selling and general administration expenses there. 8% selling and general admin expenses. It is 8%. 8% on 10,000. 8% on 50,000. Sorry, 8% on sales. 8% on sales. That is 4,000. 8% on 65,000. 8% on 65,000. Don't calculate this percentage on profit. Any percentage, any expenses, anything is given percentage, we need to calculate on sales. This percentage is on sales, not on profit. Yeah. Only 1% that we need to calculate on profit is income tax. Tax is paid on profit. Tax is not paid on sales. Tax is paid on profit. VAT is paid on sales. Income tax is paid on profit. Yeah. So 8% on sales. 5,200. 8% on 84,500. 6,760. Yeah.
Yes, sir.
Then 8% on 1,09,850.
8,788. 8,788.
8,788. Same thing. 8,788. Deducted. You will get profit before tax. Profit before tax. Gross profit minus selling and distribution expenses. That is, I am putting the number 1, 2, 3, 4. So profit before tax is 2 minus 3. Profit before tax is 2 minus 3. That is 6,000. 13,000 minus 7,800. Then 6,900 minus 6,760.
10,140.
10,000.
140.
140. 21,970 minus 8,788. 21,9. How much?
13,182.
13,182. 13,182. This is profit before tax. Then tax is given 30%. Income tax rate is 30%. Tax is 30%. 30% on profit. 30% on profit before tax. 30% on profit. 30% on 6,000. Okay. That will be 1,800. 30% on 5,000. 30% on 7,800.
2,340.
Huh?
2,340.
2,340. Then 30% on 10,140.
3,042.
3,042. Then 30% on 13,182.
3,954.6.
3,954.6. So 3,955 you put.
Yes.
3,955. 3,955. Same. Okay. So sixth one, profit after tax. Sixth one, profit after tax.
4,200.
Yeah, profit after tax 4,200. That is 4 minus 5. 4 minus 5, 4,200. Then 7,800 minus 2,340.
5,460.
5,460. Then 10,140 minus 3,042.
7,098.
7,098. 13,182. 13,182 minus 3,955.
9,227.
9,227. 9,227. Same year, fourth year onward, same. Okay. So what we calculated is profit after tax. So what we need to calculate is cash flow. We need to calculate the cash flow. So with this profit after tax, we need to add back the depreciation, because depreciation is the non-operating expenses, a non-cash item, so that need to be added back. And then we'll have to deduct changes in capital expenditure and changes in fixed assets, changes in current assets to get the cash flow. So leave 5 lines here. So we need to calculate first what is the changes in fixed assets. We have to calculate changes in current assets. Then we'll come back here. Okay. So leave 6 lines. Then we'll come back here. I'll rub it now. So what you can do is you can just seventh one you please put plus depreciation. Please put and keep it. 7th one plus depreciation. 8th one minus changes in fixed assets. Minus changes in fixed assets. And 9th one minus changes in current assets. And 10th one cash flow. Operating cash flow. Okay. So these 4 lines, keep it blank. Then we'll come back to the balance sheet and then we'll come back here to get the cash flow. Okay. So I'll rub it here so that you can come back afterwards. So we have to go to the balance sheet. Go to the balance sheet. So balance sheet we need to calculate. So balance sheet. So 1, 0, 1, 2, 3, 4. So fixed assets, what is given is fixed assets 25,000. Fixed assets 25,000 increased by 30%. When the sales is increasing by 30%, the asset should also reciprocally should increase. Otherwise, sales cannot increase automatically. You should employ more assets. Okay, so assets should equally increase. So how much? 30%, 25,000. That will be 30 to 500. 30 to 500. Second year, again 30%. Again 30%. 40,000.
42,250.
40 to 250. Then 40 to 250, 30%. It's okay. So, the same 30% increase, current assets 8,450. Then 8,450, 30% again increase, that is 10,985. Then 4th year onwards, same 10,985. Add the total, you will get the total assets, that is 30,000, 39,000, 50,700 and 65,910 and 65,910. And when we employ the 30% increase in assets, your equity also should increase by 30%. So add the same amount, put the same amount and write the liability side of the balance sheet. Now come here for depreciation. So to get the cash flow, we'll have to add back the depreciation, because why are we adding back the depreciation? Because depreciation is a non-cash item, so that need to be added back to get the cash flow. Depreciation, what is given is, please look at the depreciation. Depreciation charges will be equal to 10% of the net fixed assets at the beginning of the year. Hello? Got it? Depreciation charges will be equal to 10% of the net fixed assets at the beginning of the year. So first year depreciation will be 10% of the last year. 10% of the last year net fixed assets. So last year net fixed assets is 25,000. Last year net fixed assets is 25,000. That is a base year. So the first year depreciation will be 2,500. Got it? All you got it? The first year depreciation will be 10% of last year net fixed assets. Net fixed assets means from that figure depreciation is deducted. So 25,000 what we have is after deducting depreciation. Okay? So 10% of 25,000, 2,500. Then that is for the first year. First year 2,500. First year 2,500. Okay? Then second year. Second year how much? Second year will be 3,250. 3,250. And third year 4,225. Oh, 4,225. For second year, yeah, first year, second year, third year here. Yeah. Oh, this is the first year. Okay, sorry. So slight change here. So this is the first year. Yeah, first year, second year, third year, and fourth year. So first year will be 2,500. Second year will be 3,250. Third year will be 4225. And fifth year will be 549293. Anybody? Any doubt? Depreciation, any doubt? The first year depreciation will be last year fixed assets. That is 25,000, 10%. 2,500. Second year will be first year net fixed assets. So first year net fixed assets is 30,500, 3,250. And third year will be second year fixed assets. That is 40,250, 4,225. Okay? Fourth year will be third year. So third year is 54,925. So 54,925, 10%. 5492.5. So 5493. So any clarification, anybody? Depreciation, any clarification, anybody? Hello? Any doubt? Anybody? Got it? Merlin, understood? Hello?
This is okay, sir.
Okay. Now, come to the next one. Changes in net fixed assets. Changes in net fixed assets. Now, how much increase? How much is the increase in net fixed assets? Fixed assets, how much increase? 25,000, 0 year, increased to 30,500, increased by how much? 7,500. That 7,500 excluding depreciation. So you need to add that year depreciation also, because you are charging after this, deducting depreciation only it is given. So please add depreciation also to get the net fixed assets total. So 7,500 plus 2,500, that is 10,000. Got it? Hello? How do you get 10,000? How do we get 10,000? All of you understood? What is the difference? Difference is 7,500. Difference is 7,500. Okay? And the depreciation also of that particular year. And the depreciation also of that particular year. That means 7,500 plus 2,500, that is 10,000. Then second year, how much? Second year how much? What is the difference? Difference how much? Difference is 13. Difference is, yeah. No. 40 to 250 minus 30 to 500. 42,250 minus 32,500. How much? 9,000? 9,750 plus 3,250. Plus 3,250, that is 13,000. Okay? Then third year, difference. 54,925 minus 42,250. 54,925 minus 42,250. How much?
12,675.
Huh? 12,000?
675.
75 plus 4225. Plus 4225.
16,900.
Eh?
16,900.
6,900. 6,900. Okay? Then, fourth year onwards, please look at that. The last line, after 3 years, capital expenditure will be equal to depreciation. After 3 years, capital expenditure will be equal to depreciation. That means depreciation, whatever it is there, that is called change in capital expenditure. So that fourth year, the depreciation is depreciation of the fourth year is 5493. So the changes in capital expenditure also 5493. 5493. Okay, as per the case, after 3 years, capital expenditure will be equal to depreciation. So fourth year depreciation is 5493. So that is the capital expenditure change. Okay. Then change in current assets, just increase the total. First year is base year is 5,000. First year is 6,500. So increase is 1,500. Second year increase is how much? 8,450 minus 6,500. First year is 1,500.
950.
Huh? How much? Second year? 8,450 minus 6,500. 8,450 minus 6,000. 1,950. Third year? 10,985 minus 8,450. 10,985. 2,535. Fourth year onwards, no change. Fourth year onwards, no change. Dash. So cash flow, calculate. Base year is 4,200. Base year is 4,200. And first year is 5,460 plus 2,500 minus 10,000 minus 1,500. How much comes? 5,460 plus 2,500 minus 10,000 minus 1,500. How much comes? Deficiency. So bracket you put 3,004.
3,540.
3,540. Put in bracket. Bracket means it's minus. Put in bracket. Then the second also will be in bracket only. The second also will be in minus. Second also will be in minus. How much comes? Second one. Second one, how much?
4,602. 4,602.
4,602 minus. Then third one. Third also will be in minus. Third also will be in minus.
5,983. 5,983.
5,983 minus. Last one will be minus. Plus. Fourth year onwards will be in plus. 9,227 plus 5,493. 9,227. Yes.
9,227.
9,227. Yes. Okay, the first step is over. We'll take up the next steps in the next session. Okay, thank you.